Welcome, everyone, to another McGloin Sutner client exclusive market update. I'm Peter Van Beek.
I'm Matt Sutner.
And today we just really want to give you an update on everything going on right now with the economy, tariffs, trade talks. There's obviously a lot of uncertainty right now and volatility. So we're here to provide that update for you guys to hopefully get you more educated on everything going on and calm some of those nerves. So I think a big thing today, Matt, that we want to talk about with our clients is tariffs, which equals uncertainty, which equals volatility. Uncertainty in the markets causes a lot of volatilities and these big up and down swings in the market. So you want to provide a little bit of insight on that going forward?
Yeah, and boy, have we seen some volatility this year, haven't we, Peter? Volatility, however, is not unusual. We actually see that quite often in the market. So I want to walk you through this slide to kind of show you, historically speaking, what have we seen from a volatility perspective. So as you can see on your screen here, from 1979 through 2024, what this is showing you is the intra-year gains and declines in the overall market. So what that means is at some point in time during the year, the market has gone up and it has gone down. But how do we measure that? So what this is showing you is you can see on the blue lines, that's the greatest increase during the year. The gray lines are the greatest declines during the year. And the dots, the darker dots that you see is where the actual market ended that year. And so what we're saying here is that volatility, although we're feeling it a lot right now, tariffs are causing a lot of volatility in the marketplace. We've seen the market come way down. We've seen it shoot back up. We've seen it come way down again. That volatility is completely normal. We see that every single year. In fact, there's not even a single year during this last 45 years that we've not seen volatility. So again, seeing the volatility this year is not unusual. However, we can actually pinpoint exactly why, and it's tariffs.
Because everyone gets a little bit uncertain and a little bit uneasy when they open up those quarterly statements and they say, oh gosh, I'm down X amount, right? It's uncomfortable to see that, but it's important to know it's about the number of shares you have, not the dollars in your account. The number of shares you have is what's important. And I think the big thing, to Matt's point, if you look at this next slide here, is with that volatility, there's big swings up and big swings down, right? And the markets can change in an instant. You don't know perfectly when that's going to happen, right? And we always say is it's about time in the market, not timing the market. So if you see on this graph, this is just a great example here. Just a good place to remind everyone just how critical it is to participate in strong rallies that follow steep declines, corrections, bear markets. Case in point, you can see in this graph here is if you invested $10,000 in the S&P 500 index starting on January 1st, 1980, and then missed just the best 5 days in the market, you would have given up over $500,000, to be exact, about $621,000. That's 38% of your total market growth from 1980 until now if you just missed the best 5 days, right? Versus if you were in all the days, you can see you were at over 1.6 million. If you missed just the best 10 days in that whole market span from these dates that you can see, that's $904,000, over half your money you would have lost just if you were out for the 10 best days during this huge span here of 45 years, which is crazy to think about.
Yeah.
Right? 30 days, even more, 1.3 million, almost 84%. 50 days that you missed, 1.5 million, 93%. So it just shows you the importance of you're going to have this volatility. And this would have meant staying invested in the 1987 Black Monday crash, throughout the tech bubble, 2008 global financial crisis, the COVID pandemic. It's very hard to do, but throughout history, it's paid off. The sense of panic was just as high in those periods as it is now, and you may feel it today, but all it took was missing the best 5 days to severely impact that total return. Importantly, 70% of the market's best days occur within 2 weeks of the worst days. So it's just staying disciplined, like we say, long-term strategy, keep that in mind, trying to limit those emotions while it's hard to see those dollar amounts going down, keeping the big picture in mind. This financial journey for all of you is still 10, 20, 30, 40, 50 plus years to go, depending on your age.
Yeah, and keeping the big picture in mind is really difficult because there's so much coming at us. In today's day and age, we have media at our fingertips, literally by the second. You know, Pope Francis died recently, and probably within a minute, the whole world knew. 10, 20, 50 years ago, it would have taken many days for that news to travel. So in today's day and age, news travels quickly. And why that's important to understand is we as a firm here, we don't look at what the news is projecting, because oftentimes you see a lot of fear, you see a lot of greed in the news, but that's not what you do, what you need to be looking at as an investor. As an investor, as you can see on this slide, we actually look more at the fundamentals. We use analytics to say, hey, how should we be investing your money? And one of the things that we look at is, what are the CEOs of these top corporations saying or projecting into the future, saying how their performance is going to look? What you see here, and I'm going to walk you through this slide, is basically since the beginning of 2024 through the end of 2025, so a 2-year span, which is some of it's already passed, some of it's being projected into the future, is saying what are the quarterly earnings, which is actually considered profits, and revenue, which is the top line sales. What's the growth annualized, right? Year on year. So when you look at this is the S&P 500. These top CEOs have basically come in and said, hey, look, our earnings, which is our profit margins, have been relatively steady. Let's just say in 2024, they've been averaging, let's just say 9%. Now their top line sales were really pretty steady at about 5.5%, right? So when you look at top line sales, they're staying pretty steady in 2024. As we look into 2025, and we don't have the exact numbers for Q1 yet. These are just prognostications. You can see the top line sales, the orange bar, drop down to 3.8%. Why? Because top CEOs are saying, hey, look, these tariffs might actually have an impact on our overall sales. But you can kind of see that number creep up again. It goes to 4.4, then 5.1, then 5.4. That 5.4 is basically right in line with what the average was in 2024. So what these CEOs are saying is, hey, we might see some short-term pain with regards to these tariffs, but we think that our top-line sales are going to come back to normal. So there's some positivity, some optimism from these CEOs of these S&P 500 companies that they're looking at this saying, hey, there's going to be some short-term pain here, but we think that long-term we're going to be okay. And so you have to couple that with what you're seeing in the news. The news is probably showing you a lot of doom and gloom.
That's how they're a business, right? We always talk about how do you get people to read more of your articles, view more of your channels and viewership, right? It's creating that panic.
Yeah. And if you look over history, the headlines over history have always been that way. They've always been the sky is falling. This is the end. This is different. Well, we're seeing that today too. But the CEOs that have a really good pulse on their businesses are not showing us those numbers based on what we see in this graph.
Yeah. And I think it kind of shows you here is you have your short-term and your long-term projections here. And that kind of chimes into your short-term and long-term plans for your financial plan.
Exactly.
And that kind of leads us to that last graphic here for you guys. This brings us all the way back to 1937, almost 90 years of data for you guys. And this just kind of shows you it is normal. If you look at just a one day, there's only just slightly more than a 50% chance you're going to make money. 1 year, it's just over 75%. So that means historically, almost 1 out of 4 years, you have a negative year in the market. Now, that's not going to be perfectly correlated. You could have 2 negative years in a row and then 6 positive years, right? But it just goes to show you and why, hey, when you guys come to meet with us, we always talk about some of the most important things is, hey, what goals do you have, expenses coming up in the next couple of years? Because the short term, it's kind of like gambling. The market could go up or down, right? You don't know if you're going to lose money or gain money. But that's why we keep those goals and expenses in mind to keep that cash aside for the short term so you don't have to worry about short-term market volatility. But long-term, you can see that the longer you stay invested, the higher probability of an annualized rate of return that's positive. So you can see, extend past that 1 year mark now. You can see the 3 year, 88%, 5 years, you're over 93, 10 years, you're almost 97.5%. I would take those odds.
Yeah.
So I think it just goes to show you guys is to mute all the noise and remember what your long-term objectives are. Stay disciplined with your emotions, as that could hurt your long-term investment return and plan if you, as we kind of talked about, if you sell out and miss just the best 5 or 10 days, it can have a huge impact long-term on you. So just knowing, hey, volatility is normal. There's going to be negative years in the market, as you can see here, but long-term, you should get rewarded for being in the market long-term, staying disciplined, sticking to that approach.
Yeah, we know that you're probably looking at your account saying, man, what is going on in here, right? But that's what we're here for. We're here to talk you through what we're seeing in the marketplace And we're always willing to help you out with that.
Yeah, we appreciate you guys, as Matt said, and just like to reiterate, all of our advisors, that's what we're here for. Questions or concerns, please don't hesitate to reach out to us. It can be in between review meetings. Ask us. We're always available. So thank you guys, and we'll talk to you soon.
Bye.